A very good afternoon to all of you. Welcome to yet another edition of WealthWise with Edelweiss. I apologize that we have had some technical glitches because of which our guest today will be on an audio call. So joining us today, let me introduce our guest, is Pankaj Murarka. He's the founder and drives investment processes in Renaissance Investment Managers. He has over 21 years of experience in equity research and fund management. Today, he joins us to share his views on equity market and fixed income instruments. We will be also taking a look at an ideal portfolio in a post-lockdown scenario. There might be some lag of 10 to 15 seconds, but please bear with us. I promise that there will be no more technical glitches otherwise. So, Pankaj, I hand it over to you. Welcome to WealthWise with Edelweiss. Can you tell us about your outlook on the markets? Let's start with that.
Thanks, Anaga, for a kind introduction. Good evening, friends, and thank you for joining us for this session. My apologies for slight delay, and there's some issue with making this camera work. So I suppose I'm only on an audio. So please excuse me for that. So we'll try to make the best use of this time over the next 20 or 25 minutes or thereabouts. I'll try to share with you perspective on equity markets and how we're thinking about them. And also we'll touch upon some other things in terms of how this whole COVID issue is playing out and what could be the longer term repercussions for it for global and Indian economy. And then we can open floor for questions. So to start with, I think now we already, from an India perspective, we're already into 7 weeks of lockdown, and probably over the last 10 weeks, all of us have now probably read enough about COVID, and we understand a great deal about it. All of us clearly, without getting into too much of detail, because a fair bit of it is known to all of us by now. I think it's obviously a crisis which is unprecedented. It's a once in 100-year crisis because never ever we have seen the world being locked down in a synchronized fashion ever. This has never happened. This has never happened even during times of world wars, because while wars happened, the world was not locked down even during those times, and the economies were functional even during World War II. So while it was a more when you talk about world wars, it was a more extended event, and it impacted trade and commerce, but it never led to synchronized lockdown the way we've experienced today. Over the last 10 weeks, what we've essentially seen is 40% of the world population or thereabouts, contributing to about 60% of world GDP, has been in some sort of a lockdown, and that's very significant from any dimensions that you look at. I think now by now we've realized that this COVID will stay with us for a very, very long time to come. Just like some of these earlier diseases that occurred, be it a plague or a polio or pneumonia, and when they came into existence, they were very lethal. And over a period of time, we have found solutions to deal with them in terms of vaccination, in terms of medication, and so on and so forth. I think we'll find a solution to COVID as well. In terms of probably medicines, there's already a significant amount of work that's happening on antibodies and vaccines and stuff like that. But the fact remains that it's going to stay with us for the next 20, 30, 40 years. So we'll have to learn to live with it and probably deal with it. Probably the intensity is significantly higher today because we are fighting this disease without any medicine and vaccines. But probably in next probably 6 months at least, I hope that we'll have some medication for COVID, and probably vaccine should emerge in probably 12 months or so, as everyone is talking about. Be that as it may be, the question is, what's the path for the global economy from here on? So clearly we're seeing that there's a gradual opening up that's happening of the economies across the world. Italy and Germany have started opening their economy gradually, so is Spain, and so is US making statements about gradual opening up of the economy. In India also, we've seen the first sign of that starting from Monday of this week, where at least we've divided the countries in the different zones, and we are seeing gradual opening of the economy. My view or our view is that now that meaning while the infections rate from COVID in India, while if you look at the Western world like Italy and Spain, which the incremental infections had peaked long back. So the curve there has certainly declined significantly. As opposed to that, US the curve has started plateauing, where the incremental infections have now plateaued in the range of 20-25,000 every day over the last 10-15 days. As opposed to that, in India, we are still on an acceleration curve. We have not yet peaked in terms of number of cases. We don't know exactly where the peak lies, but hopefully from whatever I've read from some information and some calls I've had attended to, and the ICMR judgment is that probably in India we'll probably hit the peak sometime in early June or thereabouts is when we hit the peak, and then probably the curve will plateau out some point of time and will start receding or declining in terms of incremental infections thereafter from mid-June onwards, kind of a thing. So given that be the case, I think what we'll essentially witness is probably a gradual opening up of the Indian economy from here on over the next 6 to 8 weeks. And once we open up the economy, obviously economic activity has fallen through a cliff. And I'll come on, we'll discuss a bit about that in more detail. But our base view is that the economy opens up gradually from here on till end of June or early July. And from there on, probably it will take probably 6 to 9 months for economy to normalize, for us to reach a the level of economic activity that existed before the COVID hit us, that is before where we were in Feb or early March. Probably we could by the time we get there, it could be probably be December of this end of this year, probably. And within that also, obviously, I'm sure all of us understand there will be lead and lag effect. So there will be certain segments or pockets of the economy or sector of the economy which will hit normalization much earlier, where there will be pockets and segments of the economy which could even take much longer than that to normalize. For example, one sector which is clearly obvious to all of us is travel and tourism, where we'll hit where normalization might take much longer than end of this year, probably to get back to the same level of let's say travel or transportation, let's say to have the same number of passengers flying could take, to my mind, 18 to 24 months, because people will be apprehensive about traveling at this point of time. So I think it will have a different level of impact on different segments of the economy. But broadly, if I were to summarize or sum it up, essentially, our view is probably, if you look at it in terms of real economic impact of this whole crisis on the economy, and all of these things are evolving because every day we face with new situation, new information, and that keeps changing things quite significantly. But I think as we are seeing things at this point of time, it looks like probably this could be a year where our growth could be probably negative between 1 to 2%. Now that's very significant because India has never experienced a negative growth ever since 1980. The last time India experienced negative growth in terms of GDP was in 1979, 1980. So that India's of 1980 was very different than India as it exists today, because that point of time India is a very small economy from a global perspective, and today we are a very different economy because we are the fifth largest economy in the world and far more integrated into the global economy than what we were in 1980s. One second.
Acha, right now it's perfect. Now we can see you. Yes.
Perfect, is it? Am I visible?
Yeah. Yes. Please go ahead. This is completely fine.
I'm sure there'll be a round of government stimulus, but at the same time, I think all of us are cognizant of the fact, unlike Western world, the unfortunate part is, unlike US and Germany, which have done stimulus to the extent of US has gone to the extent of doing about 10% of their GDP. Germany has gone somewhere closer to that. Probably in India, we cannot afford to do a stimulus of that extent because I think our government doesn't have resources of that magnitude. And secondly, it hits India much more on a relative scale. The impact on India can be much more as compared to the Western world, because we are still an economy which is in early stage of evolution. Our per capita income is about $2,200 compared to US and US, which is at about $55,000 per capita, and Europe is again about $40,000 of per capita. So obviously it has a much deeper impact on Indian economy, and probably we're constrained from the fact that we cannot do stimulus to the same extent some of the Western world can do. Having said that, in all of this gloom and doom, I think there's significant opportunities, or there's some silver linings for India as well. Clearly, one thing is very apparent and clear, that the world is trying to figure out the source of this virus. And there are, I'm sure all of you have seen or read reports about, their concerns about the fact that, or apprehensions that the virus is not something which happened naturally, but it's something which occurred, in a Chinese lab and so on and so forth. While we don't know, at some point of time we'll get to know the truth of that as well, as and when it emerges. But the more important thing, I think, is it will mark a significant change in global geopolitics. Events like this have a significant, they change the course of history. What all of us are going through is a point of time in history, or a period in history, which will always be remembered, unfortunately, for the kind of crisis it has engineered. And when these kind of events happen globally, they change the course of the world. And I think we are living through or going through one such period. So it's very apparent now that all the advanced economies do not look upon China as a trusted partner in the global trade and in the evolution of in the growth going forward, which effectively means there will be significant resetting of global relationships. And I think therein lies the silver lining for India, because I'm sure all of us recollect last India. Just to recap some statistics, we have India is the largest supplier of labor to the world. We have about 10 million people joining our working age population every year, and that will keep happening given our demographic tailwind for the next 20 years, which effectively means we'll add 200 million people to our working age population over the next 20 years. And in that context, will be the largest supplier of the labor in India. India today has the cheapest labor probably in Asia, keeping Africa out of this equation. And India now has the lowest tax rates for manufacturing, with what we did in September last year, where we reduced tax on new manufacturing units to 15%. So obviously, and one thing which this crisis has really exposed is all these global multinational companies, while they thought that they had global supply chains, but what they've realized is all their supply chains, effectively either through the tier 1 vendors or through the tier 2 vendors, are actually not global supply chains, because 90% of those supply chains have linkages to China. So they are effectively China supply chains. And this has really made them realize the risk that they're exposed to. And I'm sure both from a geopolitics perspective and from a business perspective, global multinational companies would want to de-risk themselves from China, which effectively means rebasing of their supply chains out of China. While this is a very long-term trend and nothing can happen in a short term of 6 months or 1 year, but I think this can be a very powerful trend for a very long period of time to come. And if as India, we get our act together, then we can be a significant beneficiary of this trend going forward, because in as much as we need the world to drive our growth, and we have labor and other resources to offer to them, I think we've reached a point where the world also need us as much as they as we need them. And that's a big shift that has happened post this crisis, because the world needs India as well, because otherwise they can't relocate such significant supply chains to any other part of Asia. Meaning, I'm sure all of us know that in the past, Vietnam and Thailand have done far better than India when it comes to the location of supply chains. But then when we're talking about or discussing about doing it on a mass scale, I think even they are inept at handling or these kind of scale, because of the sheer lack of their ability to supply resources, be it manpower or other resources on that scale. Meaning all of Bangladesh taken together is about 150 million people, and Thailand is about 60 million people, so is Vietnam. So they cannot match India's scale and size in that sense. So I think there is a significant opportunity for India when we look through this crisis and look at a world which is beyond this crisis. provided we get our acts together. So I think broadly the way we are looking at it is, one, clearly crisis has an impact on India, but I think we'll have to split it in two parts. Today we're living through the crisis. We see a gradual opening of the economy over the next 3 months, and the process of normalization after that could take something like about, broadly for the economy as a whole, for about 6 months or thereabouts. The world post this crisis will be different. We'll get into a new normal where a lot of things will change. Obviously, I think one thing all of us are witnessing is the whole evolution of technology and way the acceleration of technology is happening. Just to give one data point I saw, meaning I was not aware of Zoom as a video app until this crisis hit, and all of us started using it. So while this crisis hits a lot of businesses negatively, there are businesses which benefit out of this as well, right? Because, meaning, take a classic example of Zoom. They had something like 10 million subscribers in December 19. End of March, they had their subscriber base had multiplied 20 times. They had 200 million subscribers by end of March 20. So within a matter of 3 months, their customer base went 20x. Now that's the impact, and so is, I'm sure, all of us are making increased use of Netflix and Amazon Primes and so on and so forth. So obviously it's benefiting some businesses as well. But I think one thing is very apparent, that we'll get into a new normal post this COVID crisis. So that's broadly how all of this plays out, and then we can discuss slightly more detail if you guys are interested in the Q&A session. Now, coming to what it means for equity markets perspective, I think broadly, first of all, if this is a once in 100-year crisis, I've always said that if you're a long-term investor in equities, every crisis is an opportunity. You cannot let go of a crisis, or you cannot afford to miss a crisis, because let going of a crisis as a long-term investor is like leaving a loose ball which you could have otherwise swing into the fences for a boundary. And while we don't like crisis, but from an investor's point of view, crises are always an opportunity to buy into some very long-term businesses at very attractive prices, which would not have been otherwise possible in the normal case, because the sellers would not have capitulated to an extent, and the kind of fear that exists in the market would not have brought valuation prices to levels which otherwise happens during the course of a crisis. So I think it's very important from a long-term investor point of view to look upon this crisis as every crisis as an opportunity, and this crisis is probably, I think, one of the biggest opportunity that I can see through from my perspective in my 22 years of career. Bear in mind, if this is, as all of us are saying, that this is once in a 100-year crisis because the world has not seen anything like this, and nor has India ever seen anything like this, then this is also what it also means is it is also a once in a 20, 30, 40-year opportunity from an equity market perspective. So I think for a long-term investor, this is a great opportunity to invest into equities from a slightly more medium-term to longer-term perspective, because you would not find the bargains or attractive investment opportunities that exist today otherwise in a normal functional economy. And fact remains that every crisis also have their own journey, but every crisis the world does sail through every crisis. So I'm sure this will also this too will also pass through, and this will also sail through, and all of us will move on. At least personally, I have very strong belief and faith in science and technology and biology, and I'm sure the world will find solution to this much sooner than what anyone of us anticipate, given the kind of progress science and biology has made over the last 30, 40, 50 years. So while we have to be careful, cautious, take all the precautions, but I don't think so this crisis changes the course of the world. And probably once we get through this crisis, as we discuss some of these things, probably India could I would think so. India could, in a world in the post-COVID area, India will probably emerge relatively stronger from this crisis than what we were at the start of this crisis, because of the kind of inherent advantages we had. So I think from an equity market perspective, I think it's a great opportunity for investors to use this crisis to the best of their advantage and make best use of it in terms of increasing the allocation to equities. One question which, and we can discuss more about it in details. So I think I'll stop here and we'll open the floor for questions. Probably happy to take questions. Is that good?
Yeah, I think closing on the queue for positivity is, I think, just what all the investors need to hear right now. So thank you, Pankaj, for that. I'll start with the questions. Now, uh, I think the first question is that the current market conditions, as you mentioned, are very volatile. So, do you think that the investors need to hold out on their investments, or should they consider making some market moves right now, considering that we are in the phase 3 of the lockdown?
Sorry, Manish, is the first part of the question. Can you just come back? Sorry, I missed it.
So I was asking that since the market conditions are volatile right now, and we are already in phase 3 of the lockdown, so do you think that the investors should consider on holding out their investments, or should they slowly start making market moves uh, given the current scenario?
See, the fact of the matter is every day is a new day for all of us, including governments, central banks, policymakers, businessmen, and investors, because there is no precedence for this. This crisis or what we're going through is unprecedented. There is no one alive in this planet who's seen anything like this, and there is no empirical evidence as to how to deal with lockdowns and all of that. What people are trying to do is trying to every day we are getting new information, and we're trying to policymakers are trying to build that in, and basis that they're trying to take decisions and course correct on everyday basis. Unfortunately, we don't know how markets will behave in a very short term, which is over the next 3 to 6 months. Yeah, I think what we need to understand from an investing perspective, having said that, is I think valuations from the way I see at markets is this year, FY21, financial year 2020-21, will be an aberration because as you know, this year we will see contraction in growth in India and probably in global growth as well. Global GDP probably will contract by about 3% or so. But having said that, given the kind of monetary and fiscal stimulus that's been thrown by governments and central banks across the world, probably the global economy should normalize next year, going into the next year, which is calendar year 20, which effectively means we should have a very sharp rebound in economic activity as well. So I think we'll have to look through this year because this year will be a year of sharp decline in economic activity and sharp decline in earnings from equity market perspective, and probably next year will be a more normalized year, calendar year 21. And I think markets will do that. In that context, I think markets will remain volatile over the next, talking about Indian markets, I think markets will remain volatile over the next, let's say, 3-4 months. Probably my guess is probably by July or August, by then we get a complete handle on the magnitude of impact of this crisis on each and every sector. Until then, there will be some asymmetry of information in terms of how things will play out and so on and so forth. And because of which market, there will be high degree of volatility in markets over the next 3 or 4 months. So I think it's very difficult to time the market, but I think investors, one, if you have adequate allocation to it, I also think that this is a year to go overweight into equities in your asset allocation. So if you are underweight equities or your market neutral equity or neutral equities from your asset allocation perspective, this is a year where you have to go overweight onto equities. This is certainly a year of going overweight into equities. Now, having said that, I think the best thing is to do in times like this when we are driving to an extent, you know, all of us are, including company managements. Meaning, I can give you various examples where even businesses don't know what will happen to their business. I'll just give a classic example. Let's say take the case of the largest bank in India in the private sector, HDFC Bank. Now today they have 1.5 crore credit card customers all over India. They themselves don't know how many of these customers will pay on time, will not pay, will seek moratorium, and then eventually seek an extension, and then will default because they don't know how many of those customers have lost their jobs, or they've closed down their businesses, or their businesses have been impacted, or they've been not impacted. So in a way, managements of businesses are also to an extent driving blind for some period of time. Having said that, strong and resilient businesses, let's say just like HDFC Bank, at the end of the crisis, they'll emerge stronger than what they were at the start of the crisis. So I think it's a good time to start making investments because there's a lot of uncertainty and there's new data and information that's evolving on an everyday basis. It's very difficult to pick bottoms from a market perspective. What investors should do is to invest gradually over the next 3 or 4 months. And this is a year I firmly believe to go overweight into equities.
So much, Pankaj. On that note, because you've already mentioned asset allocation, I just want to ask that what should be the ideal asset allocation for an investor right now?
Well, that will depend on the income profile, age of the investor, because that's really a function of his risk appetite, his income profile, his age, and so on. But I think for an investor who's moderate risk or reasonable risk, we generally say that he should have 50% allocation to equities for an investor with moderate risk appetite. And at this point of time, as I said, I would suggest investors going overweight on equities, which effectively means that I would say that they should increase their equity exposure by uh, 10 to 15% at least. So if they're supposed to be 50% equity, they should go to 65% or thereabouts in equities, because we have to use crisis like this to our advantage. And the thing is, buying at such low point during the crisis effectively means you're buying at a low point of low risk in equities, which effectively means your incremental downside risk are equity is risk. So there is not to say there is no risk, because there is risk always, but the risks are limited or much lower than what they would have been otherwise, and the reward is far more favorable. So the risk reward is extremely favorable from investors' perspective. And these kind of favorable risk rewards, as I said, happens once in a 10-year, 15-year phenomena. It doesn't happen every other year, So you can't waste this opportunity. All of us cannot waste this opportunity. Just think about it from this perspective. We had a crisis which was much smaller than this, but of similar magnitude, which had a much bigger impact in India in 2013, when Indian currency had gone for a toss from 50 to 70, and markets had fallen very sharply. But bear in mind that investors who used that opportunity to invest into equities at that point of time actually did well over the next 5 or 6 years. So what essentially we learn from history is investments made during the time of crisis generally tend to yield much higher returns to investors than investments made during normal course of in ordinary times. So investments made during times of crisis like this certainly yields much higher return from a medium term to longer term perspective from an investor's point of view.
Thank you so much. On that note, as you mentioned, that if we are adding stocks, what are the sectors that we should look at? Which sectors can we certainly look at? And people are asking your view on different sectors like real estate. Some are asking on chemical, pharma, and the paper industry. Could you also briefly maybe touch on those points?
Sure. So I think healthcare is one sector which we have liked. Pharma, which is the sector that's primarily because the sector had not done well for the last 3 or 4 years. It has gone through its own cycle. And I think this valuation in the sector had moderated very significantly. And this is one sector which, when you look at through this crisis, comes out as a sector which is probably much less impacted by this crisis, and probably there's some rub-off benefit on the sector as well. So that's one sector which we clearly like, and so that's one sector where we have positive view. Second, I think it's time to, my view is that it's time to bet on Indian economy. Today, the economy is completely dislocated, right? Because probably April has been a month where economic activity was down by 80 or 85%. And now that we've started gradually opening up, things will improve from May onwards. But we haven't seen this kind of a dislocation in India ever. When you look at auto sales, I'm just giving an example. Maruti reported that they had zero sales in the month of April. Now, when was the last time when any passenger vehicle company had zero sales in one full month in India? I don't think so. It has ever happened. It has never happened to Maruti from the time they came to India. Maruti came to India. I'm sure some of you might recollect. Came to India in 1984, and 1988 is when they started. 87 is when they started their production with that great Maruti 800. I don't think so they've ever seen something like that. So I'm saying there's significant dislocation in a lot of these sectors, and as the economy normalizes, a lot of these sectors will come back. So my view is probably I am constructive or positive on India as a whole, because I think India will emerge out of this crisis and over a medium term to longer term will do much better. So I would rather focus on one sectors which are related to the core of the economy, which is like autos. A lot of these sectors on a current basis might look significantly impacted. So their results over the next 1 or 2 quarters might be bad. But I think we'll have to look through that because the valuations that a lot of these companies are trading in the sectors are extremely attractive from that point of view. So autos is another sector which we like, and obviously we like private sector banks, and within that the larger banks because they'll be less impacted. So other sectors which you touched upon, so chemicals I think is a very attractive investment opportunity from an investor's point of view, primarily for the reason that again China is a huge manufacturing base for chemicals, and probably they supply something like 40% of the world's chemicals across the value chain across different industries. And a lot of or some of that or maybe a significant part of that over a long period of time will move out of China, probably because global companies want to de-risk themselves. And also at the same time, in the last few years, we had actually seen that China itself had gone much stricter on their own environmental and pollution control norms, as a result of which a lot of those companies were finding it difficult to operate in China or struggling to operate in China. And that shift of manufacturing from China to India had already started on some scale. And I think that will accelerate. So I think that's another sector which should be which should do well from a medium-term perspective. Coming back to the other two sectors you said, which is essentially real estate. I think real estate sector will take a while to come back. Meaning, I'm sure all of us know that today, and if at all it comes back, then I think the first round of recovery will be more into affordable homes than on luxury homes or residentials. And probably commercials might still do better than that, but I still think that real estate sector might take some time to come back. Meaning today, since stands 70% of developers across India will be stressed because developers as a real estate sector as it is was significantly leveraged, and this crisis really will have a significant impact on their business and business models. And at the same time, when consumers go into a spending mode, in a savings mode, excuse me, into a savings mode, I think for the time being, demand for real estate will be constrained from a consumer perspective. So I think that will be a sector which will lag the recovery and be a late cyclical recovery kind of a thing. And again, paper, I think as it is, it's a very small segment of the market. I think there are significantly more attractive opportunities that exist in many larger sectors in the economy and the ecosystem. So I think we should focus there rather than focusing on some very micro sectors like paper and stuff like that.
Thank you so much. Now I have a question. The major concern for a lot of people and also investors is that after we are through with the lockdown, we might face a major economic crisis. So a gentleman is asking that, it is estimated that India will have a -1% or 2% GDP growth in FY21. What shall be the expected stimulus which is required for the Indian economy in such a scenario?
So I think, it's a given that, meaning if it's such a big exogenous and health crisis, it will translate into an economic crisis when we go into such lockdowns, and that too for such a prolonged period of time. I think that's a given. As I said, meaning some of our research estimates based on some prima facie or preliminary numbers that we have seen is the loss of income or the loss of output, as we call it, could be to the magnitude of something like $250 odd billion, which is very significant, right? I don't think so. We can do a stimulus to the extent what some of the Western world or the advanced economies have done, something like 10% of GDP and thereabouts. I don't think so we can afford that level of stimulus. Also, bear in mind there's a difference between those economies and our economy. Consumers, companies, and households in India are much less leveraged than what they are in the Western world. In Western world, household debt to GDP or corporate debt to GDP is significantly higher than what is there in India, which effectively means our equity into our business or in our household savings is much higher. and also households exposure savings, allocation of household savings to equities in India, because equity is an asset class which has been significantly impacted because of this, is much lower in India versus what it exists in the Western world, in across US, Europe, and other parts of the world. So to that extent, from a wealth destruction perspective or impact on wealth, in percentage terms, the impact on India and Indian economy and Indian households will be lower than what will be in the Western world. Also, because Indian corporates as a whole are less leveraged than Western world, the impact on corporate India will be lower than what it is in the Western world. And to that extent, one can make a case that the need of a stimulus to that extent is lower in India versus what exists, what the Western economies have given. There is no right number as to how much stimulus should be given, because I'm sure the economy and all the constituents of the economy, people like you and me and everyone else, or companies would want as much as they can take from the government. Yeah, but at the same time, government will have to balance the need for stimulus, and at the same time they'll have to keep some broad macro framework in place in terms of how much the fiscal deficit can spike to, and when they can normalize that over what period of time, because this year is a year where fiscal numbers and macro numbers will go haywire all over the place. So I think it's difficult to put a number, because anything, meaning you can ask for the moon, right? But I think from whatever I get to hear from my conversations with some of the senior government officials and what is out there in media, probably government probably will do an stimulus, apart from what they've already done, to the extent of something like 50 to 60 billion dollars, which could be probably 2% or 2% of GDP, or 2.5% of GDP, in addition to what they've already done. So that will have some impact on the economy in terms of it will provide some support, but yet I think we'll have significant challenges. And from a relative perspective, I think it will be the smaller or the marginal businesses which will be more impacted, because the stronger businesses, the larger businesses with strong balance sheet will still sail through this crisis and emerge out of it, versus the smaller businesses which can be significantly impacted.
Thank you. So I believe that there is a stimulus obviously expected. Now, coming to from a very retail investor perspective, you had briefly touched upon fixed income also, when you were covering. So I just want to know that how should fixed income play a role in the overall portfolio of an investor right now in the current scenario, and which are the instruments one can look at? ETFs, are they a good bet? Like, in and around this, could you just take us through all of it?
Sure, I'll share my views. Having said that, before I share that, let me give you one caveat. I'm a equity investor all my life. For me, 80-90% of my savings are into equities, and that is how always it has been. And I believe in that whole philosophy that you cannot grow rich by investing into fixed income. So fixed income is important to the extent it gives you some returns to take care of livelihood. But beyond that, I think investing is all about growth. Having said that, I think investors should be prudent and make their own asset allocations, either themselves or in consultation with the advisors. When it comes to fixed income, I think obviously we've seen some challenges on the fixed income side, also from a mutual fund perspective, where some credit funds have had high credit cost or some credit cost, and the impact of that, and because of it there's some nervousness amongst investors. I would suggest that when you're looking at fixed income, don't try to, my simple philosophy always has been, when it comes to fixed income, don't try to chase yield, because when it comes to fixed income, the outcomes are binary. If the company is doing well, you get all your principal and all your interest, and if the company lands into trouble, then forget your interest, even your principal is at stake. So that incremental risk that investors take for that extra 1% or 2% yield is not worth taking, because the risk reward is extremely unfavorable, because the risk you take for that incremental 1% or 2% risk by investing into credit funds as a category is not worth that risk, because the risk for that incremental 1%, 2% reward is not really justifies taking that risk. So, and fixed income is something where you really want to be safe and have a, what I say, SIP, have a peaceful sleep at night, sleep in peace. So I think investors should look at When you're looking at funds, look at funds which have allocation to high quality papers and a reasonably high quality of portfolio, so that you know that those companies, even if meaning for see other thing is there is no one in the world who's not impacted by this crisis. From the largest company in India, let's say the largest company in India in terms of market cap today is Reliance or TCS, or the top five companies will be include HDFC Bank and so on. From the largest companies in India to the smallest entrepreneur is impacted in India by this crisis. Everyone will have different degree of impact, but everyone is impacted, and so is the case across the world. So there is no one in the world, be it individuals or companies, who's untouched by this crisis. That's the enormity or magnitude of this crisis. Yeah. So, but when you invest into high quality businesses, either owning their equities or fixed income, you know that there will be some impact on the businesses, but they will survive. And if at all in the new world order, once the crisis abates, they will thrive, because a lot of companies will not survive. So it effectively means companies which can sail through this crisis, they will do much better on a relative scale, because for them the competition in their respective industry will be much less than what otherwise was there before the crisis. So I think if you're investing into, if you're a fixed income investor, one, make sure you get your asset allocation right. Secondly, invest into funds which has high asset, which has high quality portfolio. So largely triple A's and double A plus kind of a thing. And thirdly, I think from an interest rate perspective, I think given the kind of world we live in, I don't think so interest rates are rising in a hurry. If at all anything, this whole crisis is extremely deflationary for India and world, because it sucks out growth, and central banks and governments will have to pump in a lot of money, which effectively means this crisis is extremely deflationary. And so, which effectively means that inflation is unlikely to rise for a long time to come, and which effectively means again don't be somewhere in the middle of the interest rate curve, I would say. So your portfolio should have a duration of something like 2 to 3 years, not beyond that, but probably somewhere in the middle of the interest rate curve, between 2 to 4 years is the ideal place to be there in terms of portfolio duration perspective. Just one more point I missed while talking about India. So apart from everything else we discussed, there's obviously a significant benefit to India from the fact that also we've seen simultaneously, because this crisis is a significant collapse in oil prices. And India's oil import bill is something like about $150 billion per year. At current oil prices, we save something like order of something like $40 to $50 billion per year. That's a huge national savings. So, which is why I said there's some silver linings for India as well. And the collapse in oil prices is a very big advantage for India.
Thank you so much. We have received another question that since the world is taking its focus away from China, do you think that it will lead to more foreign direct investment in India? Are we ready for it, or how will the future pan out?
That's a very interesting question. China receives FDI which is 10 times India's size, and they've been doing that for the last 15-20 years. Yeah, I think India needs, and India will need, significant amount of foreign direct investment to set up manufacturing capacities in India on very large scale. Just to give an example, I'm sure some of you are aware, there's a company called Foxconn, which is Taiwanese-based company. They manufacture 90% of iPhones that all of us use all over the world. Foxconn by itself, a single company, employs something like 5 million people in China. If Foxconn has to rebase significant part of its manufacturing base out of China, they cannot go to any other country but for India, because they cannot employ 5 million people in a single country, in any country other than in India. Other competing countries like Vietnam, Thailand do not have that scale of manpower to offer, and their wage cost for a Vietnam or a Thailand is 3 to 5x of that exists in India. So I think India will, the FDI flows in India will significantly accelerate. The second part of your question was, are we ready for it? I think we better get ready for it. If we are not, I think we are significantly ready for it. But at the same time, I think the government has some work to do in India on this, because in the past we have had sorry or bad stories around FDIs, where some of these FDI investors have gone back because they've not been able to get what they needed, and they had to withdraw or go back from India. But I think it's high time now, where the central and state governments come together, because and get their act together, and significantly accelerate execution and improve ease of doing business, because India, in, as I said, in as much as this world needs India and they're willing to invest into India, India also absolutely needs them. I just think about it. When I said that we are adding 10 million people to a working age population every year, that effectively means we have 30,000 people who are joining our labor force on an everyday basis. Doesn't matter it's a weekend or a working day. Every day, 30,000 people in India are joining labor force. So we have to create at least 30,000 jobs every day. And now all of that will not be possible without this significant foreign investment. So uh, I think it's a point in history. If we let go of this opportunity, the future generation will not forgive us. So I think we better get prepared. And I think that at least from whatever I'm seeing, I think the governments are aware of this, because also remember, apart from central government, now the state governments are struggling. Their revenues are gone, right? They will struggle to pay salaries, wages, and do developmental expenditure in their respective states, which means the state governments are equally desperate to get revenues, and that can happen only with investments. And which effectively means I think they will also be very agile and very nimble on their foot to get all these investments and make sure that whatever is required to be done to get those investments going, they'll do that.
Thank you. I will just inform our attendees that we are in the process of taking last questions. I have a question where somebody said that, there seems to be also an atmosphere of pay cuts and, people are experiencing a job loss. So it's a very simple question. How do you think that we should structure our investments in a manner to cushion against, all these phenomena?
Sorry, what was the question? How do you push against this phenomenon?
So how do we structure our portfolio in a manner that we are able to protect ourselves against, these phenomena?
So I think it's very apparent now through the cycle we are going. If you see from an investment perspective, last 4 or 5 years, consumption was one sector which was driving growth, or which was driver of the economic growth, and which was also the consumer sectors and companies within the sectors where some of the best performing companies from a investing or equity market perspective. But I think that will change for some time to come, because as you rightly said, there will be job losses across white collar and blue collar, which is why we need new investments to create new jobs. And at the same time, people would want, there will be change in behavior where people, even if there are no job losses, people would want to save much more. So the savings will improve, or savings will improve, because it has really it has come as a shock to people, and that whole psychology or mindset or approach or behavior will change for some time to come before things normalize. So I think my view is, and from even from an equity market perspective, consumer staples as a sector is extremely expensive. So I think one should avoid investing into consumer staples, because they might offer security or safety in the short term. But when I look at through the prism from a longer term perspective, I don't think so. Unlikely they'll deliver meaningful returns to investors, and there's a risk that the sector might actually underperform. Having said that, as I said, there are enough number of sectors which will drive growth. If India's growth, which I believe will get back to 7-8% in probably the next 2 to 3 years, and look at opportunities within those sectors, I think there are enough number of opportunities across multiple sectors in terms of from an investment point of view, where sectors and sectors which will lead economic growth, and companies within the sector, the leading companies within those sectors, which can be a big beneficiary of that. So I think avoid some of these late cyclical sectors, like, or sectors which are significantly leveraged, or sectors where valuations are extremely rich and growth will come back with a lag effect, which is effectively consumer staples, real estate, and probably some global cyclicals like steel or metal and stuff like that. And apart from that, I think some of the other sectors which we discussed earlier looks pretty attractive. So I think that is how investors should look at from a positioning perspective.
Thank you so much, Pankaj. Would you quickly like to summarize this webinar for all our attendees?
Sure. So, friends, I think the crisis is unprecedented. All of us know that. We'll have to learn to live with it. I think in as much as the crisis is unprecedented and it will have significant economic impact from a near-term perspective, I firmly believe that on a relative scale, India will emerge on the global landscape stronger at the end of this crisis than where India stood before the start of this crisis. And as we say in investing, every crisis is an opportunity. So if you have, I have my long-term faith in India. If you have a long-term faith in India, look upon this crisis as an opportunity and don't waste this opportunity. It's time to invest into equities, time to go over it into equities, have a 5-year horizon. And I'm sure a year down the line, we'll look back upon this period of time that this was a time when we made some good investments, which yielded us phenomenal returns, which would have not otherwise have happened. So now that we've got a crisis, let's be brave to face the healthcare crisis. And from an investing perspective, let's make the best use of this crisis. Let's not let go this crisis waste. I think that's where I'll summarize and conclude.
Thank you so much. I believe that was the positive. Thank you for ending on a positive note, and I think we all needed that kind of positivity. Thank you for the entire webinar, Pankaj. It was an immense pleasure to have you on our board, and despite the technical glitches, I think the webinar went off smoothly. Thank you for your insights. Thank you for your insights on all the sectors which you offered, and I'm sure that our audience found your expertise of significant value, and I'm sure that they're going to gain from this. To all our audience, I understand that there have been some connectivity issues, some back and forth, but thank you for sticking with us. Thank you for posting your questions. We would like to have you all back again for our next webinar on Friday. Till then, stay at home, stay safe, and stay calm.
Thank you very much.